So I recently did a video looking at some of the best companies on the FTSE 100 who pay out dividends, and to my surprise, some have been paying out dividends for a really long time, 10 years, some even more than 20 years worth of payouts. But then this got me thinking, rather than just picking those individual dividend stocks, why not buy one of the investor's best friend, an exchange traded fund, and just buy the lot?
Show me the money.
After all, that's what we say for growth investors, right? We say invest in broad, low-cost index funds over a long period of time, putting in money consistently, maybe every month as you get paid, and in the long run, you should do pretty good. So the good news is there's a ton of good, high-paying ETFs out there which track the UK market, but not just that track the individual companies within the FTSE 100, for example, and some of the smaller constituents which pay very handsome dividends and yields. So rather than having to pick those individual stocks, you would just buy a single ETF, put them all in your basket and go hopping off onto the sunset.
That's going straight in my basket.
So in this video, I found 3 different funds for you, which are all available to buy. I'll give you their name, all the information you need, including their ticker symbol. We'll briefly then look at some of the high-level information on the funds, like what they're invested in, for example, the kind of yield and the price and the ongoing costs, and then I'll leave the rest up to you as an individual investor to do your own research. For full transparency, I'm completely neutral here. I don't own any of these funds at all, at least right now. I might look at them in the future as I want to increase my dividend income. For the time being, of course, I'm a heavy growth investor looking for that long-term growth. I do have a couple of odd individual stocks which do pay a dividend, but my focus really is on growth. But these could be really good if you're looking for someone to get regular, consistent income and you've already built up a nice investment pot. So without further ado, let's put the fun back into funds and let's do this. Right, so let's get cracking. I'm going to switch over to my laptop now so we can share what I'm looking at, and I'm going to be looking at all the funds today using the Hargreaves Lansdown website just because it's really easy to use. But of course, a lot of these funds, most of these funds should be on your favourite brokerage platforms, whether that's Trading 212, Free Trade, Fidelity, AJ Bell, you name it. They're all traded on the UK Stock Exchange. So first one up in no particular order is the iShares UK Dividend UCITS ETF. This has a ticker symbol of IUKD. So you can see now I've got it up on the screen for us, so we can have a look at some of the high level information just to give us a bit of a few indicators of if this might be something we wanted to invest into. So let's go right from the top. Of course, we can look at the individual prices as it is at the moment. It's not necessarily the most important factor. You can see the size of the fund is quite handsome at nearly £750 million. Of course, is a UK fund, so it's going to be traded in pence and pounds. Always a key thing to look at. And one of the most important factors here, and certainly something to be aware of, is how much dividend income, how much dividend yield we might expect from our investment. And of course, if we look back at the dividend yield, based on how much we invest, this is how much we should expect to get back every calendar year. So we can briefly look at some of the information here. So of course, as we know, the last year has been a bit crazy for stocks, so the price of this stock's gone up significantly. If you were able to buy some of these funds down in the lows we had toward the end of last year, you would have seen some fantastic yields from a lot of these organizations. Now let's just scroll through some of the high level information. One of the most important things to look at, of course, is going to be the charges. So here we'll see the ongoing costs are 0.4%, and there is an indicative spread of a 0.1% too, the difference between the buy and the sell price. Those ongoing costs are certainly more expensive than you are going to see a passive tracker fund, but I don't think I would class that necessarily as too expensive. There's certainly a lot more expensive funds out there. Now, if we look at some of the other information on here, we can see there's 51 different holdings, so 51 different companies in this fund, and we've already said that it's nearly £750 million. So if we scroll down now, there's a couple more things which are going to be really important when we're looking at dividend-based funds and income-producing funds. We want to know as investors, when are we going to get our money? Where's my money? So the important thing here, of course, is to know that we're going to get paid quarterly, so every 3 months. So if you are looking for that monthly income, there aren't actually many funds out there, to be honest, who will give you that monthly income. So if this was your only fund, for example, you would need to budget that money and not go spending too crazy. Anyway, and a couple of important dates, of course, your ex-dividend date, the date you need to make sure you'd own the fund before you'd get any income, and then a payment date, which is typically a month later. And in this instance, it's just a couple of weeks later on the 25th of March. Top 10 exposures, so these are the companies who it's weighted more heavily toward. You won't get a full list here, of course, because that's their own information. And of course, you can see it's weighted here, so some of the big players in the market, so Imperial Brands, GlaxoSmithKline, British American Tobacco, no surprises here. And lots of these, funny enough, have been stocks which have paid their dividend for a very long amount of time. And if we think one of the benefits of ETFs generally, of course, it's that none of our eggs are in a single basket. So even if a couple of these companies, for example, were to stop paying their dividend for whatever reason or cease paying their dividends, that it won't really affect our overall payment massively because, of course, worst case scenario, we've got 5% weight in Imperial Brands, for example. So this could be a good one to have a look at. Just make sure you do all your own research as usual. And again, that ticker symbol is IUKD. So now we'll jump onto the second one. Again, it's in no particular order because of course you can't really say what the best is. We don't know what the future's going to hold. And this one's got a great mouthful of name. I'm not even going to bother saying it other than the ticker symbol is UKDV. And the good thing about this one is it covers the UK Dividend Aristocrats. So as in the States, you'll hear these terms like Dividend Aristocrats and Dividend Kings. Now, Dividend Aristocrats would have been companies which have increased their dividends for 10 years consecutively, and of course will meet a certain market size too. So these are going to be extremely reliable companies that we're very likely to see on this list, which means that as an investor, you should have a strong confidence that you'll be getting your income from this. And again, let's go through that. So we're going to see a slightly lower yield on this one at 2.59%. It's a slightly smaller fund at £136 million, so it's not significant. So it's not absolutely massive. If you had £10 million, you'd probably be one of the largest holders in this fund, so maybe avoid that one. Again, we'll see that year performance has been relatively good. So if you were to lock in that price earlier on, you would have had a better yield. Not the most amazing performance going over the last month for sure, but at the end of the day, if you're a long-term investor, these charts really shouldn't matter. Again, let's scroll down and have a look at what is going to interest us. There's a couple more things here. So 41 holdings in this fund, so just slightly less than the other one we just looked at. And ongoing charges as well, slightly less too, so that's 0.3%. So again, it's never going to be as cheap as low-cost index funds like 0.06%, but this is still very, very cheap if we expand that to the longer term. And there is a small spread of 0.15% as well, worth knowing if you were going to buy in and out of this fund quickly. Just scrolling down now to when dividends are going to get paid. Again, think about when we're actually going to get this money. This one's an interesting one here. As you can see, it's biannually. So you're only going to get a couple of payments per year on that yield. So again, if you are going to go all in on this ETF, then you want to make sure that you budget accordingly if you're going to be relying on this to pay mortgage, rent, or your food bills, or anything like that. So if we look at some of the exposures, the companies that were invested in here, we're going to see the same names very likely across these ETFs because of course it's not exactly the biggest market in the world, but we are going to see some different names in terms of the Dividend Aristocrats. These are the cream of the crop, the individual companies and organizations who've been dedicated to paying that dividend and increasing it over a decade or so. So if we look at the top 10 exposures here, that's an interesting one now. We've actually got Morrisons Supermarkets here making up a healthy 7.77%. Again, if we think about this and why this might be the case, supermarkets and general retail, regardless of economic condition, is something that we're going to need to use. So again, if we think about what happened in 2020, supermarket stocks kind of went through the roof and of course have been very, very stable over a long period of time. Others on here similar, of course, British American Tobacco, known for their healthy dividends, GlaxoSmithKline, Legal & General, Rio Tinto, lots of global names here who are going to generate their income outside of the UK and around the rest of the world. So this could be one worth looking at. Certainly lots of red numbers in terms of performance over a short period of time, but really we're interested in that safe dividend payments. And last but not least, Wisdomtree's Issuer PLC UK Equity Income UCITS ETF, and I think it's got a great ticker symbol, this one, WUKD. I wouldn't order one of them at the buy, probably wouldn't be very good for you. Anyway, let's go through some high level figures. So this one's an even smaller fund at £8.89 million, so certainly less well known. A healthy dividend yield here of 4.15%. I think realistically, I think most people will agree that if you can get any kind of dividend above 4% or more, that's quite a nice level to have. Kind of ties in with that 4% rule, which I'll make another video on, about how much you can draw down each year from your investments. And we can look at the high levels of the graph. Again, most of these are going to look very, very similar indeed. So you'd probably want to decide this based on some other factors, not just the shape of that graph. Holdings, we've got a lot more holdings here. So that's 73. So this is the biggest holdings in the list complete. And we can see it's actually got an ongoing charge of 0.29%, making it one of the most cost-effective funds to invest in, with a slightly larger indicative spread. Now, one thing to be aware of, I think, with smaller funds and smaller investments, remember you can potentially have that issue of liquidity. Not that I think this will happen to these kinds of funds, but if, for example, everyone wanted to sell out, you may find yourself struggling if there's not enough people buying and selling a share and not enough liquidity in the market. Anyway, again, like the last share, this one is a biannual payment of income, so it's not going to give you that consistent income monthly or quarterly, so just be aware of that one. And then the usual information here of our ex-dividend date of the 4th of January, so we better get our move on if we want to make sure we get this one bought. And now looking at the top 10 exposures, again, Lots of similarities, but a couple of different ones here we're seeing, like Diageo and Relics, who I actually spoke about in my last video looking at dividend payments. They've been a really reliable dividend payer over many, many years now, a lot more than I expected, to be honest. And some other ones popping up here again, Vodafone, GlaxoSmithKline right there at the bottom, Aberdeen Investments too. So anyway, that's a wrap for today's video. I hope you've enjoyed that. I've tried to pick several different ETFs here which you might want to look into. As always, please do all of your own research. I wouldn't put all my eggs in any single one basket, but if you are looking for some kind of income, even if it's just part of your portfolio, then an ETF which focuses on income and focuses on dividends, especially in that UK market, might be something worth investing in for you. Anyway, drop me a fat like if you've enjoyed the video and you made it this far. Congratulations. To anyone brand new, please consider subscribing for many more videos. If you're already part of the journey, thank you so much for your support, and I'll see you guys in the next one. Happy investing.